Before building a financial model, it is very important to understand how the financial statements are structured for a particular company. In this video, we are going to understand the first element of financial model, that is profit and loss statement. Here we will understand each and every line item of P&L statement using a case study of Sandy Sandwich Private Limited Company, which is a startup in F&B segment. Modeling the current P&L statement will help us to take good assumptions for the future forecasted. Hello everyone, welcome to module 3 of this financial modeling of a startup series. My name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers, we help people build successful career in finance. So let's get onto the screen and understand this entire module in detail. So here we are at module 3's introduction to profit and loss statement. Let's understand what are the points that we are going to cover in this entire module. So first is we are going to understand what is P&L. What does this entire statement stand for is what we are going to understand in what is P&L. Next, we are going to understand how does it work. So what is the purpose of building an entire P&L statement? So that is what we will understand over here. Next, we are going to understand types of expense. Here we are having COGS, which will help us understand the gross profit. Next, we have operating and non-operating expenses. So here we are going to understand each and every line item of expenses that a P&L has. So as we understand the entire P&L line items, we will work on case study of Sandy Sandwich Private Limited, where we will model the entire P&L statement of the current year, which will help us understand what is the business doing as of now. And in the second video of the module 3, where we are projecting the entire P&L statement for next 3 years, we will be able to take better assumptions as we understood the entire structure of current financial statement of Sandy Sandwich Private Limited. So let's get started by understanding the P&L statement. So first we will understand what is a P&L statement. A P&L statement is a summary of company's income and expenses over a period. So as we see over here, it is written that it is a summary of company's income and expenses over a particular period. A P&L statement helps company maintain record of how much income is the company earning and how much expense is it incurring towards various items, and this entire summary is maintained for a particular period. Now this period could be a month, it could be a quarter, it could be a year, depending what the business requirements are. In India, as per rules and regulation, you have to create a P&L statement for 1 year period, which starts on 1st of April every year and which ends on 31st March for the next year. And as you create this entire P&L statement based on the profits that you have earned for the year, you have to pay taxes to the government. Next, we will understand why is a P&L statement important. So first point, it shows whether a business is profitable or loss making. This is the most important point for any company that is doing business. So as we saw in the first module where we covered the 3 financial statements, we saw that every type of a company indulges into business to make profits, and through P&L statement we can understand if the company is making profits or is it incurring losses. If you have not checked the first module, do check it in the I button. You will have a detailed understanding of 3 financial statements that we are covering in the next modules. The second point is it helps assess the operational efficiency. So when we understand the operating expense of a company, this point becomes very important, and we understand if the business is making profit on the operation basis. And the final point is that investors use it to track growth and margin trend. So when you go for raising funds through investors, the first requirement that an investor puts is you have to share your financial statements with them. Over here, you will be sharing the previous 3 to 5 years of financial statement, and then investor will have a detailed analysis on it, where they will track the growth of your company, what are the margins, what is the profit that you have been earning, how much are you expending towards each and every item in your business. So P&L helps to track this entire margins and growth trajectory for a company. Next, we are going to understand how does a P&L work. So the first point, P&L starts with revenue, subtracts all type of COGS, then all the operating expenses, and ends with net profit after subtracting all the non-operating expenses. So it is a kind of a funnel that you create while building a P&L statement. So it starts with revenue, then you subtract all the COGS, that is cost of goods sold. Next, you are subtracting all the operating expenses, and the final point is it ends with net profit. It ends with net profit after subtracting all the non-operating expenses. So non-operating expense is subtracted before coming to net profit. So that is the entire structure of a P&L statement, starting with revenue and ending with net profit. So the revenue is termed as the top line of business, and profit is termed as the bottom line of any business. So investor track both of these two growth rates and then make decision if they want to invest in a particular company. The second point over here mentions that it follows accrual accounting, not cash based. Income is recorded when earned. So as per the accounting standards that have been set by the government, the P&L statement is built based on the accrual accounting. Now, accrual accounting means that your income will be recognized when you have earned it. So let's take an example that you have a business where you are making soap. Now you sell this soap to various retailers in your client base. Now when you sell them, you are not going to immediately receive money from them. So let's assume that you sold 10,000 worth of soap to one of your client, and these clients said that he will be paying after 30 days. You will be recording this 10,000 in your books of account as soon as you have sent out this good to the client, right? So you have earned this income in your books and you have not collected yet. So this 10,000 will be in your revenue and you will be showing a receivable item in name of your client. So that is how the entire entry is created for this 10,000 amount. So these were some of the main elements that we had to understand about P&L statement, and from this we can make a key outcome that P&L statement helps us understand are we making money from what we do. So that is the main thing that you will look whenever you are analyzing a P&L statement. So next we have a case study of building financial statement for sandwich company. So here we are going to build a P&L statement, and in the coming modules we will then be building balance sheet and cash flow statement. So here we have the entire template ready with us for creating a profit and loss statement for this company. We have built this on Excel, and in this video we are going to fill up this entire template as we go through each and every line item. So the first element of the P&L statement is revenue. So before moving to revenue earned by the company, we will first understand what revenue is and how we are going to record in the books of account. So the first point about revenue, it represents total income earned from the core business activity. Example over here will be sandwich sales, as the company that we have taken is a startup outlet who is selling sandwiches to people. As we read through it, we can easily understand that it is representing total income that we have earned from the core business activity. So every business has their core business activity and it is mentioned in the AOA and MOA of the business. So whenever you are registering your business, you have to define what your company will be doing to make money. And in the P&L statement, when you are recording revenue, that entire income should be earned from that business activity, which is mentioned in the AOA, that is Article of Association, and MOA, that is Memorandum of Association, which is mentioned in your business filing. The second point about revenue is that it is recorded when goods or services are delivered, not necessarily when cash is received. So this we understood in the previous slide, where we saw if you are having a business of soap, when you are selling it to your client, you are recording the entire amount in your revenue, even though the cash is not yet collected from the client. So that is what this line over here is explaining, that it is based on the accrual concept. Next, revenue can include different streams. So as we have taken an example of sandwich outlet, the revenue streams could be dine-in sales, catering orders, online deliveries. So this way every business would have different streams from where they would be earning revenue related to the core business activity. And the final point, gross revenue may later be adjusted for returns, discounts or taxes to get net revenue. So here let's assume that in the previous example of soap, where you sold 10,000 of soap to your client and you recorded 10,000 in your books of account as revenue. Now this will be gross revenue that you have recorded. Now out of this 10,000 worth of soap, let's assume that your client returned you 1,000 worth back because they had defect in packing. Now this 1,000 will be considered as returns and will be subtracted from your 10,000 amount, and the final revenue that you will be recording is 9,000 from these particular client. And that is the difference between gross revenue and net revenue. Now apart from returns, you will also reduce discount that you are providing to your clients or the taxes that you pay to government. So the entire amount that you realize when you sell something is gross revenue. Now after you pay off the discounts, returns or taxes, you then calculate the net revenue. These are some of the highlight points about a revenue. Now about the case study, we have mentioned that Sandy sold 10 lakh worth of sandwiches this year, which is equal to 10,000 units at 100 each. Now we are going to record this in the financial statement that we are creating. So as we understood that revenue is the top line, so it comes right at the top of the entire profit and loss statement, and here we are going to mention revenue, and in the amount section we are going to add 10 lakh as the revenue earned by the company. Okay, so we have the first line item added to our P&L statement, that is revenue. Now let's move on to the second line item, which is COGS, that is cost of goods sold. So as the name suggests, it is the cost that you are incurring for the goods that you have sold. So the first point, COGS are direct costs related to producing the goods sold during the year. Example, raw material. The increase or decrease in revenue will affect this cost. So this point is describing the nature of the line item, where it is saying that whatever thing you are selling out to your customers, the expense that you are incurring to produce that particular product will be considered as COGS, and this cost increases or decreases based on the revenue that you have earned. So let's assume that you are earning higher revenue, then this cost will definitely increase because you are selling higher number of products. And if your revenue decreases, this cost will reduce as you sold less number of products. So for the example which we have taken over here of Sandy Sandwich Company, the COGS include bread, vegetable, cheese, sauces, packaging, which are the items that we will definitely need to produce a sandwich and to sell it to a consumer. And over here we are going to take only the used items. So let's assume that we had 10 bread packets in our outlet and we used only 8. The 8 bread packets will be only considered for the COGS amount and not the remaining 2. The remaining 2 will go to inventory, that we will understand when we are creating balance sheet for this company. The third point, COGS help calculate gross profit. So gross profit is also an important line item when we are understanding business at high level. So the formula of gross profit is revenue minus COGS. This we will understand when we calculate the this we will understand when we plug in this. Point number 4, a high COGS percentage may indicate inefficient sourcing or pricing strategy. Here COGS percentage means that how much revenue you are incurring towards raw material. If that percentage is very high, you are having an inefficient sourcing. So this means that you are purchasing your raw material at a very high rate, or you are selling your products at a very low rate. And the formula of COGS is operating inventory plus purchases minus closing inventory. This we will understand when we create the entire balance sheet and when we get understanding of the term inventory. Now for our example, let's plug in the COGS amount in the P&L statement that we are creating. The amount is 3 lakh incurred towards bread, cheese, vegetables and packaging. So let us plug in the 3 lakh amount as COGS in the P&L statement, and the amount over here is 3 lakh. Okay, so we have the first two elements of our P&L statement, that is revenue and COGS. Now we will be calculating the gross profit of Sandy Sandwich Company. So let us calculate the gross profit, which is equal to revenue minus the COGS. So here we are going to calculate, this will be equals to revenue minus the COGS. Enter. So here we have figure of 7 lakh as the gross profit for the company. Now we are going to calculate the percentage of gross profit based on the revenue. So here we will calculate the gross profit margin. So we will term this as margin, and the formula for margin is gross profit divided by the revenue. So the gross profit margin is 70% for the current year. Now after COGS, there are all the operating expense that a business incurs. So the operating expenses are all the expenses that you incur to run the operations of a business. And the first over here is employee benefits, which means that expenses incurred towards the employees that your business has. So we have 4 points to understand about employee benefits. It covers salaries, bonuses, allowances and benefits that are paid to employees. So example, you are paying 100 towards salary, 5 rupees toward bonus, then you are giving 3 rupees as an allowance and 2 rupees as the benefit to any employee. The total expense that you will take as employee benefit will be 110. Next is it includes contributions to PF, ESIC, medical insurance if applicable. So as per law, if business exceeds a number of employees in the company, they have to compulsorily file for PF, then give ESIC, that is employee insurance, and finally medical insurance to all the employees. And the cost that is incurred toward all the expenses will also be added to the employee benefits over here. The third point is that employee benefits are differentiated from contractual labor or freelance cost. If your company hires any kind of labor work or people on contract basis, then amount paid to those people will not be considered under employee benefit. And if you have taken any service from freelance people, the service charge that you are paying to those freelancers will also not be included in employee benefit. For Sandy's company, this could be payments to chef, servers or helpers which they have in on full-time basis in the company. So over here we have mentioned Sandy has two employees for which he is paying 2 lakh in salaries and bonuses. So we will plug in this 2 lakh rupees as employee benefits below the gross profit as the first operating expense of the company. So back to model, now we have employee benefits that we are paying at rupees 2 lakh to employees in the company. So the next element of operating expenses is SG&A, that is selling goods and administration. To understand SG&A, we have points over here. First is SG&A covers all indirect costs needed to run the business, not tied to production. So as we understood about COGS, that entire amount that is related to production of a particular good will be termed as COGS. And if you are incurring any other expenses around a business which is not related to production, those expenses will be considered as indirect cost and will be plugged into SG&A. The examples of SG&A could be marketing, legal fees, rent that you are paying, the admin salaries, IT tools, utility bills that you are incurring for running the business and not the production. It is often the most controllable area for cost management. Whenever a company goes into loss making, the first element that they try to reduce in the expense side is SG&A, because the COGS, which is directly tied to production, cannot be directly reduced at a very high level, or else your production will directly reduce. So to get company back to profitability, the area that you try to control is SG&A. So here you could reduce the marketing expense, you could try moving your office to a lower rental area, or you could try to use limited IT tools rather than using lot of databases or software. So that way you control your expenses on the business and try to get business to profitability. High SG&A may hurt profitability unless matched with growth in revenue. So as we discussed about that, if you are incurring lot of cost related to SG&A, your business might get into losses, and to match that you will then have to earn high amounts of revenue so that all your SG&A expenses are getting covered. Now for the example of Sandy's company, here we have SG&A as marketing, for which they are spending 20,000. We have legal fees where they have consultant for food licenses. Now since it's an F&B business, to sell out your products you need a food license, so here they have paid 5,000 as a legal cost. And for the professional fees, they have accountants fees which is at 15,000. So the total SG&A that Sandy has paid is 20 plus 5 plus 15, which is equals to 40k in the current year. We will add this SG&A to the P&L statement. So here we have added SG&A and the amount incurred towards SG&A is 40,000. So that is what we have added. So we have now incurred two types of expense. First is COGS. Then we had a look to all the operating expense that the business has occurred, which was employee benefits and SG&A. So after operating expenses, we get EBITDA, which is the operating profits for a company. So we are going to calculate EBITDA of the company. So EBITDA will be equal to gross profit minus all the operating expenses. So based on our P&L statement, this will be equal to gross profit, that is 7 lakh, minus 2 lakh, and minus the 40,000 incurred towards SG&A. So here we have final amount of 4,60,000 as our EBITDA. Now similar to gross profit margin, we will calculate the EBITDA margins at which the company is running. So to calculate EBITDA margins, we will divide EBITDA by the revenue that we have earned, which was 10 lakh. Here we can see that Sandy's company is making 46% EBITDA margins after taking into consideration COGS and the operating expense incurred for running the business. After taking into consideration all the operating expense, now we are left with non-operating expense of the business. Here we are going to have an overview of the non-operating expense, because to understand in detail we need to understand the balance sheet line items as well. So all the non-operating expenses are also termed as non-cash expenses incurred toward business. So the first element of non-cash expenses, depreciation and amortization. The first point explains about depreciation, that it is non-cash expense that spreads the cost of fixed asset over useful life. Over here depreciation is used whenever you are purchasing any kind of asset for business use. So in the example of Sandy's company, we have oven as our asset. Now when we purchased an oven, for example, let's assume that we purchased oven for 10,000 rupees. We did not directly expense this 10,000 in our P&L statement. Instead, we took this 10,000 rupees as our asset, and then we depreciated this entire 10,000 amount over the useful life of an asset. So this is the flexibility that accounting standard gives us while we are accounting for assets and depreciation. So over here, basic difference between non-cash expense and operating expense is that whenever you are expensing out for any operating expense, let's assume for employee benefits, whenever you pay an amount, you have already received the service for that. But whenever you are purchasing an asset, you are spending amount so that you get future benefits out of it. So if you are giving out 10,000 to a particular employee, you have already taken the service from that employee and are paying out in exchange of the service that you have gotten. But in case of asset, it is entirely opposite. You are paying money so that you get the asset and make use of that asset for future. That is why you make parts of the entire amount that you have spent over the life of that particular asset. So coming back to example, if the oven was to be used for the next 5 years, you will divide this 10,000 by 5 and every year reduce 2,000 from that particular asset and use it as an amount of depreciation. So that is what the first line over here means, that you spread the cost of fixed asset over useful life. Next point is depreciation is equals to physical asset and amortization is equals to intangible assets. Now in physical asset, it could be grill, fridge for the company that we have taken, and on the intangible part, it could be license, goodwill that the business has earned. We will understand these types of asset when we take the balance sheet module. For now, let's move on to third point, which is depreciation reduces taxable income but doesn't involve cash outflow in current year. So as we mentioned in the example that this 2000 will be incurred as depreciation in the P&L statement, but this 2000 has not been incurred on an actual basis. So this is a non-cash expense and it does not reflect a cash outflow for the current year. Depreciation is shown in P&L and adjusted in cash flow under operating activities. So after operating expense, all the non-operating expenses are mentioned and depreciation is one of the line items over there. And when you create a cash flow statement, at that time also you take into consideration depreciation. We will understand that when we create cash flow statement entirely. So for our example of Sandy's company, Sandy bought a commercial sandwich grill for 1 lakh and furniture for 40,000. Its value depreciates 10,000 a year and 8,000 a year respectively. So over here, the two assets that we have in our case study is a sandwich grill and furniture, which totals at 1.4 lakh, and the depreciation for every year is 18,000, which is 10,000 plus 8,000. So we will take this 18,000 into our P&L statement. Okay, so over here we have added depreciation and amortization, and we are going to plug in 18,000, which is the amount that we have incurred for depreciation. So next we will move to the second non-cash expense that we incur in the business, which is interest. So over here, interest is cost incurred on borrowed funds like loans or overdraft. So as we had understood in the first module that a business needs money to run its operation, and it can raise funds either through equity or through debt. And when a business raises funds through debt to run its entire operation, you have to pay certain interest. Next point, it is shown below operating profit and it is part of financing cost. So over here, financing cost means that all the costs that is incurred towards raising of finance. So for an example, if you are taking loan from the company, there are a lot of other charges like processing fees, handling charges for the documentation and all that are related to raising of these funds. Now these all the expenses can also be added to financing cost and shown as an expense in the P&L. The final point is it doesn't reduce operating efficiency but affects net profit. So over here, as we have seen that operating efficiency is seen before non-cash expenses or the non-operating expenses of the business, which is measured by EBITDA and the EBITDA margins, and it only takes into account all the operating expenses incurred. Since interest is subtracted before the net profits of the company, it definitely affects the entire net profitability. So for our example, Sandy took a loan from a bank of 1 lakh at 15% interest. The interest expense for this year is 15,000. Now the interest expense incurred for a particular loan can be of two types. One is flat interest versus another one reducing balance interest. So in this, flat interest is a flat rate on the entire principal amount that you have taken as loan. So for our example, Sandy took a loan of 1 lakh rupees. Now 1 lakh rupees at 15% will be 15,000 as an interest. On the reducing balance side, whenever you pay EMI back to the bank, your principal is reduced by a particular amount, and then the interest for the next month or the next year is charged on that particular principal amount and not on the entire amount. So that is meaning of reducing balance versus the flat balance. So for our example, we will now plug in the interest amount of 15,000 into our P&L statement. So we have added interest, and the amount that we have for this interest is 15,000. So that way we have now added both the non-cash expenses into our P&L statement. So after subtracting all the various types of expenses like COGS, operating expense, non-operating expense, we are left with profits before tax. So the formula for profit before tax is EBITDA minus all the non-cash expenses. So here we will be calculating our profit before tax as EBITDA minus both the non-cash expenses, that is depreciation and interest, and we are left with amount of 4,27,000. Now the final line item that we are left with is the taxes that we pay to the government, after which we will finally get our net profit that we have earned as a business. So to understand taxes, we have 3 pointers over here. The first is taxes represent amount a company owes to the government on its profit. So most of the government charge companies based on what they have earned as profit. Each government has different type of tax rate that they charge to companies, and to calculate tax expense you have to multiply the PBT, that is profit before tax, into the tax rate. And the final point is that companies may have deferred taxes, tax credit, or tax losses, which we can check from the notes to account that are submitted in the annual report. So when business incur any losses, they get tax losses to harvest in future profits. So that way they can reduce their entire tax rate that they are paying to the government. And in our example, we see that Sandy paid 20% taxes on the profit before taxes amount. So we will model this entire 20% in our model. And to calculate taxes, we saw the formula, which was profit before taxes, that is PBT, into the tax rate, which is 20%. So we get the amount of 85,400 paid as taxes to the government on the profit before tax that has been earned by Sandy's company. And finally, to calculate the net profit of the company, we will have to subtract profit before taxes minus the taxes that we have paid to government, which is equal to 3,41,600 only. So that way we completed the entire P&L statement for the current year for Sandy's company, which is Sandy Sandwich Private Limited. After going through each and every line item in detail, we understood what was COGS, what are different type of operating expense, and finally what are non-cash expenses or the non-operating expense of a company. So hope this video helped you understand what a P&L statement of a company is and how it is structured in step-by-step manner. In the next video, we are going to model this entire P&L statement for the next 3 years, taking detailed assumption on each and every line item for the P&L statement. So see you in the next part. Until then, this is Karan Damania taking your